Hello everyone and welcome to video number 5 in the How to Trade series. Now this might seem a little bit like I'm just trading the S&P, and that's because mostly I am. I don't like trading Forex, and I kind of think that if you learn a market then you get very good at it. So what you can see in front of you is my morning analysis that I put on our Discord server, and what I've done is I've marked the Asian session low and the Asian session European high. And what I was expecting was that the US boys would open the market, they would take the Asian session low, and then they would go up and try and take the Asian session high. But there's a problem. The Asian session high has a liquidity void above it, and that liquidity void is from this point here to this point here. So liquidity voids are usually areas where the market will retest and then move away from. So for me, this was a very interesting area to look for a trade. Let's have a look closer. So this analysis was posted on a forum called Forex Factory. So this is sometime later, and what you can see, because I put the analysis back on this chart, is you can see that that was the Asian session European high. There was your liquidity void. There's my entry. And this was the Asian session European low. And you can see they did exactly as I expected. They took out the Asian session European low, took out the Asian European session high, and then they dropped it. And this is kind of a typical move on the S&P. They love to get traders the wrong way. And this used to get me an awful lot of the time. I used to be going, well, most people would be, as soon as they see the breakout, they go short. And they put their stops on the high. That's a good target for the market makers. So then they run it back up, they take out your stops, and then they reverse the market and take it in the direction that they originally wanted to go, having taken your stops. Why do they do it? Well, the thing is, everyone that went short there put a stop up at the high, so that puts liquidity above that high, and everyone that went long here put their stops below the low. So that's going to mean that we've got liquidity down here. And if I put a little block just to remind myself where liquidity is, it's below there, because of course if you bought this market on the anticipation that it was going up, that's a good place to put your stop. Except it isn't, because it makes you a target for the market makers, because you are basically supplying the liquidity that they want. They can't just jump into a market and sell anywhere, because if they do, what will happen, if they start selling, they will push price down against them. And that means that they will keep chasing lower prices down. That's not what they want to do. What they want to do is they want you to sell to them. So everyone that was buying that market there, as the price pushed up, the market makers were selling into them. They must have been, because we got this big spike to the downside. Now I have a couple of places that I should be careful. One is the middle of the range. So if I drag this down here, you can see that the middle of the range is right at this point. And this isn't too scientific. That's the middle of the Asian session range. So that's where fair value was. And all you have to do is find the extremities and just find the halfway point. Now you can see that the range has expanded, and if we really wanted to find out where fair value is, all we'd have to do is pretty much the same thing. We just have to put the line on the top like that. We put the other line down on the bottom like that, and then we just measure between the 2 points, and that tells us where fair value is. So once you know where fair value is, you know where you don't want to trade. You don't want to trade at fair value, because there's no advantage for you. Everyone thinks that's a fair value price. In a market, you want to trade at the edges of fair value in the anticipation that they're going to push it back to fair value. And that's exactly what they did today. So now the market's at the fair value price. That maybe should have been an area I should have taken a profit, because that would have been a good trade, and down to there would have been about 61 points. Not a fortune, but you know, money in the bank. The question is, if we start to trade below this fair value line, the opportunity comes again for us. Once we go underneath it, we might then get a pullback to fair value again, and then because we're trading underneath the fair value, we know that we have the possibility of making a short trade. Well, I've got a target down there. I don't know if it will be hit, but I'm quite prepared just to sit this trade out and just let it possibly hit my target or not. What I don't want to do is knock myself out of this trade, because I think potentially we could actually go down to here, which would be down around this little spiky level here. Now, we've got quite an interesting pattern forming on the hourly chart, and that pattern is a pattern which I learned when I began my trading. They call it Pinocchio's nose. And Pinocchio's nose pattern, I'm really not kidding you here, there is such a pattern, is a very specific pattern. Let's go into it and have a good look at, could this be a Pinocchio's nose? So, as we all know, or we should do from our childhood days, that Pinocchio, when he lied, he developed a long nose, and price actually does exactly the same thing. So if you had a resistance level, which we've actually got up here, and you got a strong push candle into it, which is exactly what we got, and then you get a reversal candle with a long tail, long wick. If the next candle closes as a down bar, or even as an up bar, it doesn't really matter. The possibility is that you are going to see a reversal. So as this market here is losing a little bit of strength, and that bar is becoming weaker and weaker. It's becoming weaker because it's forming a doji, which means that the buyers can't hold price up, and it's being beaten down by the sellers. So this Pinocchio pattern, it might be a green, or in my case white, then red, my case black, and it could be a green bar, or it could even be a red bar. So we change that to red, and that would be a very nice confirmation. Now, you can get all sorts of flavors of Pinocchio's nose pattern, and at the end of the day, they sometimes work, they sometimes don't. But if you couple this together with levels, you will have very, very successful trading. And I always look at liquidity voids. And in fact, we even have an indicator which will automatically draw them on your chart. In the next video, I'll go into exactly what is a liquidity void, how you can spot it with your eyeball, and how they can be very useful in your trading. Well, if you like this video, please like and subscribe. It really helps the channel. And join our Discord server. It's free, and we've got a lot of great guys on the channel. It's good fun. Well, thanks very much for watching, and I see you next time.